I just wanted to start on this slide because I think it's so important. It's how I ended segment one, but it's important to appreciate the combination of Russia and Ukraine from a steel exporter perspective. So we're talking about 43.8 million metric tons coming from Russia, Ukraine. And when you look at how dire things already are on a problematic standpoint from supply chains, from the availability of steel, and then everybody's like, well, we'll just go green. I mean, don't worry about it. We're going to go green. It's like, well, how much steel is in all of this stuff? When you look at wind power, solar, EV, hydrogen, all of these problems, again, it's not just one piece. Like how much neon is in a solar panel? You know, it's based on the chips that go into it. EVs, same thing. Again, it's not to pick on EVs because ICE vehicles are going to face something very similar, but it's just showing the problems and the cracks where it's not just, oh, well, switch over and everything will be fine. It's like, that's not how this works. And the underlying problems continue to persist. Now, when you take all of these problems and then you look, let's just start looking at the federal budget. So the federal deficit has technically improved to 9.2% of GDP, well off the pandemic peak of 18.6 and at the same level as early 2011. So it's still not great. It's just when you look at the comp, it's a little bit easier to see kind of where we sit. Now, as I said in segment one, I didn't think the Fed was going to start selling down its balance sheet, but as we've been talking and speaking, the minutes came out and they said that the Federal Reserve signaled it will reduce its bond holdings at a maximum pace of $95 billion a month. So it's just maximum. You know, they could slow it down, but that's more than what I was expecting. And it just goes to show that they are concerned about where things are sitting, what are some of the problems in the market, and how they're trying to get in front of it, especially when you start looking at US dollar support rates, because they're trying to avoid what could be a very detrimental wage spiral. So now when you start looking at the federal deficit, because it's a deficit, so we have to go out and borrow. So as rates continue to go up, the cost of borrowing, because we don't only just borrow, we also roll. So every single week we compound the issue and it's going to cost us more and more to do so, creating these underlying problems. So then when you start looking at the estimates from the economics, show rise in inflation means an average U.S. household has to spend an extra $5,200 a year or $433 a month compared to last year. So when you think about how that impacts, and we keep talking about disposable income, discretionary income, you know, the top quintile, obviously, they're gonna get hit with $10,000 additional a year, but they can weather that. That's not a huge ask for them. Again, it's not an ask that they'd love to do because $10,000 is still $10,000. I'm pretty sure if you saw $10,000 on the ground, you would rush and fight someone to pick it up. So, because I don't know if you guys have ever negotiated a car or a house, and they act like, oh, it's just $200. It's like, okay, well, take $200, throw it on the floor, and ask them how quickly somebody's going to try to pick up those $200. It sounds small when you're buying a car that's $35,000, $40,000. What's $200? But when you segment it out, that's a lot of money. And a bottom quintile is, they're hit with $2,200, which almost $2,300, which is a huge impact when you consider underlying prices, where they're going, and how real wages are not keeping pace, which is just going to continue to make this worse. And all of this leading to a rising rate. So when you look at where rates are, there's an expectation for 50 basis points. I think that it's very likely. Do I think we get multiple 50 basis point increases? At this point, the answer is yes. My view was that we were going to get back to back 25 basis points. That is clearly wrong based on how aggressively we've run up. And I do think we get several 50 basis point increases until we get in front of this and until they start to kind of slow down some of this inflation. When you look at natural unemployment, which is about 4.3% unemployment rate, we're at 3.6 to 3.7. So we're running hot. The housing running hot. There's a lot of things that have to be cooled off. And here is an easy example of how. And just to give you an idea of just where the market is, the bond yield, the volatility, you get an idea of bond volatility is continuing to go higher, and it's going to draw, again, equity volatility. So this is just kind of showing you just what is in the market, the issues in the market that continue to conspire against any type of normalcy, if you will, in the market. So all-in funding costs for corporates are still low, and I think that's important to appreciate. It's like it's still low. We're not seeing this massive increase in pricing, but it's closing that gap, and it's happening quickly. We already have mortgage rates over 5%, and that's going to continue to increase borrowing costs, especially when you start looking at what the Fed is doing now that they've talked about selling down more of that paper, because as they sell down the balance sheet, they're going to put more paper into the market that has to be absorbed, which again, pushing down price, increasing yield. So then when you start looking at some of the other pieces of the loan balances, so even though all of this, we're still getting loan balances expanding. When you look at the consumer, large parts of the consumer, this is the first time in a long time they haven't had credit card debt. There were some benefits on the back end of COVID, so there is some of that pent up demand for lending, and that's when you're starting to see the consumer loans coming back up. Total loans and leases coming back to kind of the peak right before 2020. So again, you're starting to get some of those back in. I just think that consumer loans are starting to slow again just because rates are coming back up. There was that quick push, lock in these great rates right now before things increase exponentially, lock them in and move on. And that's when you had some of that leading indicator. And then easier U.S. bank loan standards signal future loan growth. So standards are still easy. Rates our Fed funds rates are still only 0.5. It's not like they've exploded. It's just the expectations that they go up. So it's still easier money. There you can still lend. I had to go out and get a car loan to replace my car for due to the wreck, and the wreck was, I was able to get 0.25 APR because of all of the different benefits, and now I was able to lock in 2.49. So well above where I was, but 2.49% on a car is still really good if you think about historic. So again, just kind of putting things into context. Then when you start looking at the shifts in borrowing costs, you have to think about the borrowing costs. Mortgage servicing is collapsing. Costs are inverting on the inverted chart, are increasing exponentially. It's because of the 30-year, the 10-year, the steepening of the curve, if you will. We had an inversion, and now you're starting to see that back end go back up. And again, that's putting that pressure on mortgage services, and especially now with the Fed selling some of its balance sheet, there's two pieces on that. There's treasuries and there's mortgage-backed securities. So again, that's going to push things down, and that's going to put more pressure on ISM manufacturing. And to give you an idea of kind of where things are, so as consumer sentiment continues to fall, you can see that we're still super low, because typically things get better, you start to raise rates, you start to kind of normalize, but rates essentially did nothing all the way from 2010 up until, they should have been raising this whole way up, but instead, things stayed low, and here we are way behind the 8 ball, which is why the likelihood of 50 basis point increases becomes more and more likely, especially when you start looking at CPI on a 2-year basis. Now, this is as of February 28th, so it doesn't pick up the huge surge that we had again in March, but 2-year change in CPI inflation running at multi-decade highs, but 2-year change in wages, salaries never jumped above the global financial peak and has started to roll over. So even as inflation is running at multi-decade highs, salaries are slowing. And again, that's that piece that we're talking about back to earlier when we look at inflation and what does that cost to them? And if their wages are not keeping pace as inflation continues to grind higher, that becomes a much bigger issue. I thought this was a good chart. Thank you, Energy Cynic, for flagging it. And inequality by educated played a major role. But you have to think about a college-educated person typically going to own a home, typically going to have a 401k. So when you look at the assets they are sitting on, they just increase in exponential value. Now, the problem is how much of that was paper value and how much of that is real value. So did people lock in their gains? Because unless you lock in your gains, and I absolutely hate the billionaire index of, Zuckerberg, gained $15 billion in wealth today. You only gain that wealth if you sell. It's paper wealth. Unless you lock it in, it could go away tomorrow. And it has for Zuckerberg on Metaverse. Just like if you didn't sell your 401k at the peak, you also got wiped out. So again, it's just a matter of how much equity did you lock in. So again, this is why I always think things like this are a bit misleading. But it's true because to a point, because if you owned a home, if you owned an asset, if you had assets, crushed it. But when you start looking at recent trends, the high cost of living and inflation is increasing in fear. And when you look at when was the last time we had this type of fear, it was in 1983. So the problems are not new per se; they're new to a generation though, and many generations. I mean, many people. I guess fortunately or unfortunately, I only saw the last 2 years of a rate rising cycle in 06 and 07. So, I mean, I started in this industry in May of 06. So it's not like I have this crazy experience. I try to be a student of history, so I understand what happened in those points. But that is a big problem, and that's what we're going back to. And a lot of individuals that are sitting in seats have never really seen something like this, which is why a lot of this is going to be unknown, and we have to be prepared for a lot of pain. And all of that comes down to real disposable income. So when you look at what it is, it's 3% below trend, and it's falling below. I mean, it's still above where we were in 2020, but think about the pressure that's coming through. Now, personal savings is below the threshold that we've had. It's the lowest since 2011, and it's below that's kind of set range that we have from 2015 to 2019. So savings rate edged up slightly in February to 6.3%, but remains below pre-pandemic levels because people have to pull money out of savings. Coming back to, again, real disposable income, the pressure that's coming in there, and as that continues to spread throughout the system. And all of this leads to, look at sticky inflation. It's still nowhere near where we are on flexible, that orange line, which is now above where we were in 1970 and essentially all of the 70s and 80s. So flexible and CPI for the 12 months has never been at this level. Just put that in your mind's eye. But sticky inflation is still sluggish. It's still slow. Now, we do think it catches up. We don't think it gets really to those 1970 levels, but the Fed also wants to avoid that, which is why we're seeing such aggressive action now and such concern and movement to kind of cordon this off. Conference Board consumer expectations fell. It's the lowest going back to 2015. And consumer confidence expectations index to present situation, it's at the lowest level that typically happens for recessions. When you look at where things are going, the problems that we're hitting, and again, these are the issues that remain. But when you start looking at the inventory, so when you look at a gauge of U.S. inventory building hit a record in February. So the pace at which the inventory was built increased in February. People were trying to restock, but you also, as we've been talking about, you had slowing retail sales. So as sales slowed, you had some of the supply chain pick up, you had some of those deliveries come through. So now you're sitting here, you have the ability to skip a trucking shipment. You have the ability to skip a shipment. As we said in segment one, you had a big increase in trade in February, and this is where it all showed up. And now that's why we think there's going to be some of that slowdown as we progress forward. Conference Board labor differentials, remains at all-time highs. So again, labor market is still there, but plan to hire is coming down. So jobs plentiful is still there, but the plan to hire is diminishing. So again, this is another reason why they feel comfortable. The Fed feels comfortable raising rates. They're dual mandate, inflation, max employment, and we're above max employment. So again, this is more of those pressure points. Now, when we start looking at what is happening on some of the leading indicators, ISM manufacturing fell in March to 57.1 versus the estimate of 59, lowest since September 2020. New orders dropped considerably from 61.7 to 53.8, still expanding, but a big drop nonetheless. Supplier deliveries eased, as did backlogs in production. As we said previously, prices paid, though, surged to 87.1, while employment rose to a one-year high. So we're seeing employment that'll start to cool down. Prices paid, again, back to the highs. But When you look at new orders, the leading indicator, you're seeing that big drop. And that's some of the bigger problems that we're seeing and some of the issues that we continue to highlight, because that's the key leading indicator. It's still growing, it's still expanding, but at a much lower rate of change. And we think that more of that pressure comes as prices rise, in consumers slow, and again, leading to some of that slowdown that we've been talking about. But now on the service side, things were fairly strong. March ISM services rose to 58.3 from an estimate of 58.5. But remember what we were saying, where we thought goods were going to roll over and services were going to come back up. So it wasn't that goods were going to collapse and services were going to stay down. It's that you were going to have the alligator, on, like the mouth, essentially collapse and on itself, where goods were going to come down, services were going to come up. And so we expect services to be strong. We think it'll start to slow as we progress through April and May, still be positive, still be expanding, which is why when we talk about the U.S., we don't think we're in a recession yet in the U.S. Like, that is not a thing that we've talked about. Things are slowing, but growing. So we're not there yet. So then when you look at in February, new orders, business activity, prices paid, backlogs, and inventories and new export orders all rose, all a positive, except prices paid. That's obviously an issue. Inventory sentiment dipped back into contractionary territory, but employment climbed back into expansion. So again, you're starting to see some of this mixture between manufacturing getting worse, services getting better, and how is that going to play out over time? But manufacturing production, again, coming down, new orders coming down. So the new orders is going to lead to the production. So again, both of these are pointing to those slowdowns, which are that negative leading indicator. PMI employment, that'll start to come down as well. When you look at production, it'll still be expansionary, but it's going to kind of stay within this range. But when you look at ISM new orders minus ISM inventories, you get an idea of how we're below 50. And that's the contraction we're talking about. That's the leading indicator. Now, it's not a perfect one. You get ebbs and flows. It's just we don't see this big bounce. So that's, again, going to pull that ISM manufacturing much closer to 50 and show that continuous slowdown, expanding above 50, but still that anchor that's going to pull us lower. Then when you look at ISM services PMI, you get an idea of how far we've fallen. We're kind of right here, but prices paid are still at I think that's at or near all-time highs. And that isn't changing anytime soon. And those are the pressure points that are going to remain in the system as we look at inflation and that underlying backdrop. New orders, again, ISM manufacturing new orders, negative 0.7. ISM prices paid, as we were saying, right back to the highs. We're going to stay and just go up and down, back and forth with spread between new orders and production components within March. ISM manufacturing index has collapsed and is at its lowest level since, again, late 2020. All of these negatives continue to come through, all the while prices continue to rise. So the stockpile state of America, real inventory investment as a percent of real GDP, it's the highest since Q2 of 15. Again, these are things that, as we talked about in Q4 of 2021, as that inventory build stays high, as consumption slows, that's going to put pressure on Q1. We're going to have growth. It'll probably be either just above or just below, 1%, might be at 0.8. Again, it's still going to be positive, but the trend is moving in the wrong direction. Then when you look at Dallas manufacturing, fell to 8.7 in March versus the 11 estimate. Outlook dipped into negative territory. Again, new orders, shipments, production, hours worked, all fell but are still expanding. So again, just that slowdown that continues to just rear its ugly head. Bounce back for March Chicago PMI. So this is where it all depends on where we are, which is why there's a bit of that mix. Chicago PMI came in at 62.9 versus 57. Prices paid and new orders rose at a slower pace, but still expanding. Prices paid, obviously, another issue. Inventory, supplier deliveries, and production rose at a faster pace. Inventories and supplier deliveries is actually not a positive. Again, that's why when we look at things, because inventories building is a net, it's a short-term pop, but also shows some issues when you look at consumption and consumer, buying. And then supplier deliveries getting worse. Again, that is a net negative when we look going forward. And some of the reasons why is concerns on availability. So the U.S. consumer is getting concerned about power, energy, what is the cost? And that's when you, as the concern rises, that's when you start to see that consumption really start to get hit. And when you start looking at which of the following, if any, have you done in the past 6 months because of higher prices, cut back on dining, cut back on driving, canceled trips or vacation, those things are going to continue to be an overhang for growth. Which of the following, if any, will you consider doing if higher price persists? Again, not eating out as much, driving less, canceling trips. And the canceling trips, if you can see in one, over the past 6 months, only 29% of respondents canceled trips. But if prices stay here, 40% said they would consider, would do it. And again, that's where we see that slowdown as we go into the summer months on how much travel, how much expansion, what does demand look like going forward. So then when you look at U.S. households, they're still sitting on a lot of wealth. The problem is this is holistic. And as we showed before, a lot of this is weighted much towards the top end of the spectrum as the lower end continues to struggle, as we're going to show in the next segment. Then when you look at U.S. personal, the PCE, which is what the Fed looks at, 6.4% increase in Feb versus the estimate of 6.4%. Month over month came in at 0.6 versus the estimate of 0.5. Core was at right in line at 5.4% versus the estimate of 5.5. All of this just continues to show the amount of pressure on the consumer and in general. So then when you look at personal income came in at 0.5% versus the estimate, 0.1% in the prior month. Spending was 0.2%. Versus the estimate of 0.5. But then when you adjust it to real personal spending was at negative 0.4% versus negative 0.2% estimate. That's the problem. The real spending is where we continue to see that slowdown. And when you start looking at how consumers are looking at the market, they're Googling about inflation. They're Googling about food prices because that's what they're seeing and experiencing and getting hit with. And that is some of the underlying pieces on why the pressure is going to remain. And then when you start looking at the change from year over year in hourly earnings, leisure and hospitality starting to roll over, all private workers rolling over a bit. Again, not rolling over, this big steep drop, but again, they're not continuing to grow, which is why when you look at real goods, exports, imports, that's the slowdown. So even though we're seeing a net increase in what we're bringing in onshore, when you factor it for inflation, it's actually slowing as things continue to, again, become more sluggish. So that's what we have for you in this segment. In the next segment, we're going to kick off with jobs, go deeper into personal spending, and then talk more about housing and the real estate sector in general.